Hi, welcome to another video. This one will be looking at stock valuation. Let me first start by reminding you that the fair value of any asset is the present value of all the expected future cash flows that you think or market participants think will emanate from that asset. So present value of all future cash flows, emanating from the asset whose value you're trying to estimate. This is called valuation. So that's the basics. Now let's make a distinction. We've talked about bond pricing and valuing equities, equity referring to common stock shares. Valuing equities is more difficult than valuing bonds, at least three reasons why. One, with bonds, there's a finite number of cash flows. So I'll say with bond valuation, there's a finite number of cash flows. And if you think about it, the expected cash flow stream is known in advance, up front. You invest in a corporate bond, 3% per period coupon, you're going to get $30 every 6 months for 20 years, and then you get $1,000. That's the expected cash flow stream. Sure, it might not come to pass. The company that issued the bonds could go bankrupt. Lots of stuff could happen. But it's a heck of a lot easier than valuing stocks because you've got this expected cash flow stream that's known up front. Another thing is the discount rate. The discount rate for bond valuation, whether you're using one or multiple with S in parentheses, is more easily determined with bonds. Much more easily determined with bonds, the discount rate. So with stock, you've got all sorts of issues relating to risk, and you're trying to get reflective market rates, maybe applying the CAPM pricing model to do so, to get a cost of equity. But with bonds, you can just go out and you can see the zero coupon yield curve, and you can, with some degree of difficulty, attach a risk premium then to value corporate bonds. But it's much more easy. This discount rate concept is much more easy to grab for bonds than it is for stock shares. Okay, and that's kind of a big deal that's the case. And so we've got finite number of cash flows with the expected cash flow stream known up front. Discount rate is much more easily determined for bonds than it is for stocks. And I guess the third reason would be the expected cash flow stream is known in advance. So finite number of cash flows, not in with bonds. Now remember, this is with bonds. Okay, that's how we're structuring this with bond valuation. Okay, finite number of cash flows with bonds, expected cash flow stream. This is cash flow. Cash flow stream is known up front. And discount rate for bond valuation is much more easily determined than the appropriate discount rate for stock valuation. So you keep that in mind. Valuing bonds, I'm not saying it's easy. I'm just saying it's a lot easier than valuing stocks. And now let's get into stock valuation. Often introductory investment analysis textbooks will provide examples of bond valuation. I'll just do them real quick here. One is to assume the dividend stream is a perpetuity. Okay? Remember, we said the value of any asset, the fair value of any asset, is the present value of all the cash flows expected to emanate from that asset. And with stock shares, the only cash flow that is associated with owning a share of stock is dividends. Now, sometimes people say, well, wait a minute, what if I sell my stock? Then I get money. Well, yeah, you do, but remember I said the only cash flow is associated with owning stock. If you sold your stock, common sense says you no longer own it. And the reason that's incredibly relevant is because the person that bought it from you, if they're behaving rationally, bought it in anticipation of some future cash flow stream. Okay? Companies don't have to be paying dividends now to have value. There has to be some expectation in the future that they'll be able to. Okay? So we assume the dividend stream is a perpetuity. Then you just use your standard perpetuity cash flow. So the present value of a perpetuity is equal to perpetuity cash flow times a present value interest factor for a perpetuity. This is directly out of Finance 304. I have a whole playlist reviewing these interest factors, and you can look through it. You'll become an expert if you spend a lot of time with it, and that would be a good thing. The world needs more experts. Okay, so this is it. And so if let's say we're at some date 0 and we're looking at the cash flows 1 period from now, 2 periods from now, 3 periods from now, and lasting forever, right? And this is where we are. This is the current date, right? Then, we need something that's going to give us the value at that date. And so we start with this cash flow here. So I'll call it cash flow. And since they're all the same, I'll just call them cash flows because they have the same value because it's a perpetuity. That's the assumption in this little simple model. And so obviously the stock price is the present value of the perpetuity, and that will equal the cash flow. Let's just assume it's $1 times a present value interest factor for a perpetuity, and that of course is 1 over, I'll call it R, the appropriate opportunity rate of return, whatever that is. So if it happens to be 10%, so if R is 0.1, then this is $1 times 1 over 0.1, which is 10. So $1 times 10, $10 would be a fair value for the stock. So that's just kind of simple. And then a second model you often see in introductory investment analysis books is to assume that the dividend stream is a growing perpetuity. So the idea is you have, let's say at date 1, you have a $1 expected dividend, and at date 2 you have $1.05, and at date 3 you have, I'm going to note that this is $1 times 1.05, and that makes it easier because this one here, cash flow at date 3, will be $1 times 1.05 square. It's going to be a little more than $1.10, of course. Okay, and that is the 3 dots indicates that continues forever. So this is assuming it's a growing perpetuity. What? The cash flow stream from the stock. Assume it's a growing perpetuity. Oops, PERP. And of course, from Finance 304, the present value of a growing perpetuity is growing perpetuity cash flow number 1 times a present value interest factor for a growing perpetuity. And the first one is the first one in the stream going forward. We'll assume again that we are at date 0. So, and we need the value then. The multiple cash flow stream present value factor, PVGP, is built so that you get the value 1 period prior to the first cash flow. So here's the first cash flow, so 1 period prior is date 0, so we have our our picture drawn just correct, and it'll move this one back 2 periods and so on. Again, watch my playlist on time value of money to review that if you need to. And so growing perpetuity cash flow 1 is 1 period into the future from now. If we pretend we're at date 0, that's at date 1, so it's $1. And the present value interest factor for the growing perpetuity is 1 over R minus G, where R is the appropriate opportunity rate of return, and G is the growth rate of the cash flows, okay? So sticking with our assumed R of 0.1, we'd have $1 times 1 over 0.1 minus, obviously the growth rate up here is the 0.05, okay? And so this would be what we have, and so we have $1 times 1 over 0.05. This number here, of course, is 20. Right, so it's $20. Right, $20 is the expected value. Oops. The expected value of that stock. So this is what you see in books. I'd like to provide you with a third one that's more realistic, not totally realistic, because we do make some assumptions, but I'd now like to show you a case where we assume that a dividend stream looks like this. My periods in this example are quarters, 3 months. So here's date 0. We want to value this stock now, and here's date 1. There's 2, 3, and 4. And the dividend there we're going to pretend is $1 per share each quarter. And then here's date 5, 6, 7, and 8. Now that's the next year. We're just going to pretend that the the dividend then becomes 5%. That the dividend rather increases 5%. So this is $5, $5, $5, $5. You see what's different here is you have 4 ones, then 4 $5s, and then you can guess at date 9, 10, 11, and 12, it's for all of these, cash flow is going to be $1 times 1.05 square. And then ... meaning that this goes on forever. Okay? ... this goes on forever. This is our assumption with respect to the cash flow stream, the dividend stream of the stock stated in per share terms, and we're trying to estimate the per share value of the stock. Okay, so this is what we have going on here. So, well, when we look at this cash flow stream, 1, 1, 1, 1, 105, 105, 105, 105, then 1.05 squared several times, and then 1.05 cubed, and then it's nothing we recognize. It's not an annuity. It's not a perpetuity. It's not a growing perpetuity. It's not a growing annuity. It's none of those. But if we kind of look at it, stare at it for a while, I like to say, then you say, well, what I see here is an annuity. And then what I see here is yet another annuity. And then what I see here is another annuity. And all right, let's see if maybe we can somehow work something out with this. Let's see. Well, I know that the future value of an annuity is equal to the annuity cash flow times the future value interest factor for the annuity. Okay? And just looking here, I know my future value of annuity application formula, this thing right here, is built to give us the value as of the date of the last cash flow. So with this first annuity in the amount of $1, if I apply this formula, it's going to give me the value right there at date 4. And so let's plug in. My annuity cash flow is $1, and the FVIFA is going to be characterized by, well, let's see. We have an R and an N to can be concerned with. Well, you know from your 304 exposure to interest factors that the interpretation of N with a future value interest factor for an annuity is the number of cash flows in the annuity, and there are 4 cash flows in that annuity, so N is 4. and R is the appropriate opportunity rate of return, let's just assume that that opportunity rate of return is 15%. I'm going to assume it's 15%. And I'll note per year, okay? Per year. Okay, so the future value of the annuity then is $1 times this. You'll remember it's the FVIFA formula is 1 plus R to the nth power minus 1 over R. So plugging in here, we've got now, the way I stated this, I say my R is 0.15 per year. If it's 0.15 per year, are we looking at annual data here? No, these are quarterly. Oh yeah, right? We have our growth rate, which is annual, which is 5%. But the formula we're dealing with now is dealing with quarterly growth rates, okay? Oh, very interesting. So we need to find a value. I'm just going to be lazy and make it easy on myself. And I'm going to, so the point we just made was that we don't want per year. We need per quarter for this. So I'm just going to use a nice round number. Okay, so you can now forget about the 0.15 that's right there. And I'm just going to erase this part right here. And I'll put it in a different color so you remember. So I'm going to make it 0.04 per, and I'll cross it out and say QTR for quarter. Okay, QTR for quarter. And now you'll never forget that because it's crossed out and it'll stick in your head, okay? So our value of R, the quarterly opportunity rate of return, in this example is now 4%. So when I write in here, I get 1 plus R, which is 0.04. N is also 4, and N is 4 to the 4th power minus 1 over 0.04, okay? And I'm going to call that A. I assume we can all do arithmetic, so rather than waste time calculating that, we're going to call that A, and I'm going to put A right here, okay? Now, I'm going to do the same thing with this annuity, okay, a $1.05 annuity, and I'm going to calculate its value as of the date of its last cash flow, which will be date 8, and I'm going to call it B. I'm going to call it B. Okay, so B then, well, the formula is going to be almost exactly the same because R is the same, N is the same, the annuity has 4 cash flows, the opportunity rate of return per quarter is assumed to be the same, and it's just that this value here, instead of being $1, is going to be $1.05. So I put $1.05 times, and then it's the same thing. I'll even put it in green to remind you of that. Okay, 1.04 to the 4th power minus 1 over 0.04. And that is going to be B. Okay? And then I guess I'll do it one more time out here, the 9, 10, 11, and date 12. I'm going to put a little box up here. I'm going to calculate the value of that annuity as of date 12. I'm going to call it C. I'm going to call it C. That's supposed to be a C, so there, C. And then C is going to be equal to, well, everything's the same except for the cash flow. And cash flow is 1.05 squared dollars times 1.04 to the 4th power minus 1 over 0.04. Oh, okay. And that's C. And now, there'd be a D and an E, and it would never end. So that's how it works. But the reason I had to point out A, B, and C to you was so that you could look at these values, A, B, and C. And in order to solve this problem, we're going to look at the A, B, and C, D, E, F, G, whatever, never-ending stream, and try to think what that would be called. A never-ending stream of cash flows that increases by the same percentage amount. Wait, what do I mean increases by the same percentage amount? Well, look here. How much bigger is B than A in percentage terms? Well, obviously, 5%. How much bigger is C than B? Well, this is obviously, make it real simple, this is 1.05 times 1.05. And so if that 105 is this one, then multiply it by 105, it's 5% bigger. And that never ends. D is 5% bigger than C, and E is going to be 5% bigger than D, and never ends. So with that in mind, what is this cash flow stream, A, B, C, D, E, F, G, all that? It's a never-ending stream of cash flows that increase. It's an imaginary cash flow, okay? But it's a never-ending stream of imaginary cash flows that increase every period by the same amount. But that sounds like a growing perpetuity. Well, that's quite interesting. So it ends up that we can use our growing perpetuity cash flow formula to estimate the value of this stock. I'll just remind you, the present value of a growing perpetuity equals growing perpetuity cash flow number 1 times a present value interest factor for a growing perpetuity. And growing perpetuity cash flow number 1 will be A. Okay, so it's A, which is, I'll just right now put it A, put a circle around it, times PVIFGP. Well, there's no n in that, right? There's no n because it's infinite. But there is an R and there's a G. So this is a function of R and G. Now, G is the growth rate of the cash flows. So we can say PVIFGP for G has a value of, obviously, since we're looking at the A to B to C to D, the annual thing, the growth rate of the cash flows is obviously 5%. But what is the opportunity rate of return? Because it was 4% per quarter. So here's the, don't trip up on this one. It's just going to be equal to 1.04 to the 4th power minus 1. So that's the value of R that we use, 1.04 to the 4th power minus 1. Now, is that going to be more than 16% or less? Well, you know it's going to be more than 16%. Okay? So I don't want to get bogged down in just the arithmetic, that this is what it's going to be. Okay, you can do the arithmetic on your own. That'd be good practice for you, maybe. You know what you need to do to learn. Okay? So this is the formula then. Okay, so let's just kind of fill it in. Switch to red. Okay, A was $1 times, reminding you where it came from, right here. Okay, 1.04 to the 4th minus 1 over 0.04. That's A. Okay, all of that is A. Okay. And then here we've got our present value interest factor for a growing perpetuity, which is, I'll just write it out here, 1 over R minus G, 4 cases when R exceeds G. And in our case, we've got 1 over R is 1.04 to the 4th minus 1. That's R. Let me just erase that. There. Okay. 104 to the 4th minus 1. That's R. Minus G. And our G, of course, is the rate of growth of the cash flows annually, and that's obviously 5%. So minus 0.05. And so here we have the answer. Okay, that is the value of a stock if we assume the stock begins paying a $1 dividend or pays a $1 dividend one quarter from now, 2, 3, and 4, and then after that, the next payment at date 5 increases by 5%, and then there are 4 total at that new value, 105, and after that, it increases by 5%, so the cash flow at date 9 would be $1 times 1.05 square, and there's 4 of them, and then that continues forever. And if that's our circumstance, and if the opportunity rate of return per quarter is indeed 4%, then the value of this stock will be as determined right here. So that's a neat thing. It's not perfectly realistic, but it's much more realistic than what you typically see, and it allows for companies to have streams of dividends that are constant and then have a growth rate, but the idea is the growth rate is assumed to be a constant. So if there were a weakness in this model, then it would be that the growth rate year over year in the dividend size would be assumed to be a constant. But it's still an interesting idea and good for you to look at. So again, that's all I have. Thanks for watching.